So I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes. All you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know. Again, it'd be terrific to know what's going to happen in the economy, but I deal with facts. If inventories are going up, if copper prices are going down, if room occupancy is going the wrong way, people building too many hotels. I look at freight car loadings, I own railroad stocks. I deal with facts. I don't deal with people tell me something's going to happen in the future. The first point is know what you own. I can't believe how many people own stocks and they couldn't describe to an 11-year-old in 2 minutes or less why they own this thing or what it is. I frankly think it's a tragedy in America that the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. That the big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week, and next week it's the Argentina fund, and they get results proportionate to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on usual lows, they push them on usual highs. For someone that can sit back and have their own opinion and know something about an industry, this is a positive.
Behind every stock is a company. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on. You're saying, I believe strongly this company's going to do well. If you start to see symptoms that's not going to happen, the stock's going to very rapidly respond to that. If the company runs out of steam, the stock's going to run out of steam. Suppose you've made a 50% gain on two companies. One is a fast grower with a long way to go. The other is a big, lumbering, slow growth company that has already saturated 95% of its market, and that market itself is growing slowly. The 50% return is fantastic for the slow grower. The chances are it's time to sell it. The same 50% return will be just the tip of the iceberg for the fast grower. Fast growers, if successful, will always eventually slow their growth. They'll run out of places to go. Cyclicals experiencing long down cycles may become turnarounds. Once recovered, they probably will be cyclicals again. One thing we can say about companies in general, it's easier to go from $100 million in sales to $200 million in sales than it is to go from $10 billion in sales to $20 billion in sales. So smaller companies tend to have more upside potential than larger companies. But don't dismiss all big companies out of hand. Some big companies defy their size and find exciting new ways to grow their earnings. As well, good opportunities exist in companies that are cyclical, regardless of their size.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. And that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
The price of a stock will follow the direction of earnings. In almost every case, you can generally state if a company's earnings go up sharply, the stock's going to go up. If earnings go from very poor to mediocre, the stock's probably going to rise. If they go from mediocre to good, it's probably going to have another rise. If it goes from good to excellent, it's probably going to have another rise. Or if a company's earnings grow dramatically over a long period of time, the stock's probably going to go up dramatically.
If you really understand a company, you should know how it plans to make earnings rise. A company with a long history of earnings increases and dividend increases is obviously a stable performer that has a reasonable chance to continue to perform well in the industry. But just because a company has had a great record in the past does not mean earnings will grow terrifically well in the future.
I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated.
Price-earnings ratio is something that some people make very complex. It's actually very simple. If a company is selling $100 a share and earning $10, it has a price-earnings multiple of 10. The PE ratio can be thought of as the number of years it will take the company to earn back the amount of your initial investment, assuming, of course, that the company's earnings stay constant.
The higher the PE, the more expensive the stock relative to the company's future earning power. A fairly priced stock is a PE that's about equal to the expected annual growth rate over the next 3 to 5 years. If the PE is substantially higher than the growth rate, the stock is normally expensive. If the PE is substantially lower, the stock is probably cheap. Stock PE, in part, depends on the industry that it's in. When you look at a growth company, compare the company's growth rate and its own PE to that of the industry. All other things being equal, if you find a company with a much lower PE and a higher growth rate, you're off to a good start.
No one can predict the stock market. They try to predict the interest rates. I mean, if anybody could predict interest rates right 3 times in a row, they'd be a billionaire. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate, with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you would be very useful to know what the stock market is going to do. It would be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, our interest rate's going to be 12%. That's useful stuff. You never know it. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down someday. If you're not ready for that, you shouldn't own stocks.
So I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes. All you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know. Again, it'd be terrific to know what's going to happen in the economy, but I deal with facts. If inventories are going up, if copper prices are going down, if room occupancy is going the wrong way, if people are building too many hotels. I look at freight car loading, so I own railroad stocks. I deal with facts. I don't deal with people tell me something's going to happen in the future.